Hello, welcome to a December 29th, 2013 market overview. This is the last market overview until the new year, so congratulations on making it this far. And we're looking here at our four charts as our standard majors setup: Euro USD and Pound USD on top, US Swiss and US Yen on the bottom. And as you can see, the US Swiss and the US Yen are not going the same direction. We have our EMA 21, Swiss on the 4 hours below it, trading below it, and on the US Yen is trading above it. Now the Pound US, or the Euro USD and the Pound USD are a little more compatible, but even with that, our patterns are slightly off. So we're not getting a lot of consistency as far as the dollar bringing consistency to the table. So we want to be careful how we trade. And as we go and look through these currencies, which we're not going to even look at the Swiss, but we'll look at these other three, you might want to just stay out of the market this week. Of course, end of the month, coming into the new year, not a bad idea when the charts are in this kind of condition to stay out. Now I am going to recommend a predictive trade on the Aussie USD, and I'll show you that. There's actually a possible harmonic setup coming, and there's some possible scalping that you could accomplish here on the Pound USD. I'll show you that. But let's take a look starting at the Euro USD. Clearly we have this nice rejection candle and some nice long red candles, which would be a possible temptation to just jump in if all you were trading were candle patterns. But we want to kind of take a look at what's going on a larger basis. So let's start with the monthly, and I'll show you why I'm cautious of shorting this at this time, besides the time of year. You're not going to miss much if you just stay out of the market for the next week, but I want to put this video out for you just so you can see what I'm looking at. We've come in, we've pushed past 50 on this retrace. We pulled a Fibonacci, swing high to swing low. We've pushed past the 50, and the next, for this to be any kind of a harmonic pattern, we'd look to come up into the 88%. Now if this was an ABC, at the very minimum, we'd want to see a 127% extension off of this A wave, which is going to put us roughly up into this area, into some resistance. The problem I have with that, with this actually dropping back down on the monthly, if we're using any kind of harmonics, is that this came more into an 88 retracement into this wave. Now we could be doing a triangle, okay, and then break out the bottom, but we could also break out the top. So we just want to be cautious with the euro right now, and really you're going to be trading this, if you're trading the euro, because of how choppy it's been, probably on lower time frames, and make sure that you get that, in this case, the break of the low here and then a retracement back up in. These candles, we've had a lot of this choppiness, and these candles could reverse back out fairly quickly. So that's all I have to say about the Euro USD. I'm not really going to go too much into that. Now the Pound USD, a little bit more possibilities here. We were looking at this resistance level to see if we were going to retrace back down and come into like somewhat of an expanding channel. We were looking to see if we were going to drop, and if we drop down to the weekly, we can see that didn't happen. We actually consolidated around that resistance, broke up through, and found support. Looked like we had a rejection candle. We were waiting for that to break. This candle would have been our signal, and we're looking to break below that. We never did. So at this point we're bullish, and you can see divergence developing. I'm going to deal with divergence on the Aussie USD, but let me give you a preliminary on this. From this point, what I do for my beginner students to help them find divergence, this is a momentum oscillator, momentum 10, and what we'll do is go ahead and draw a vertical line where that oscillator starts going down. And see where on the candles were still going up. Now go to your last candle, put it right over there on top, and so in this area where the candles are going up, we want to see if the oscillator is going down for just that area. If it is, then we have divergence. So clearly we have divergence here, which shows us wave exhaustion. We can use some Fibbo levels to see where that wave exhaustion might end. And there's a couple different Fibbo levels we can use. One would be to pull from what we would call X wave. You intermediate students would understand this. X wave, then A wave, B wave, and then presuming this could be C wave. That puts us 127 extension is our first resistance level we're looking for. Notice how that tops out. If we come out to the monthly, you can see how that comes in nicely at this resistance. So there's certainly a possibility there, not necessarily for a long-term drop, because we want to be looking to see if we are going to come up into this resistance level, but certainly for a move back down, find some possible support again. Now, I'm not advocating trading this right now. Where I would look for, if you want to be somewhat aggressive, is a retrace back down into this support area. Still looking for a bullish maneuver. If we get this as an ABC and we move down, we find support. Notice how there is really not divergence. If we come down where how I showed you to find divergence, notice how the candles are directly following the momentum oscillator directly. So we don't have divergence. We have a steep momentum drop, but we also had a steep drop in our price action also. So if we move down into this support level, even with say an 88% retrace, that might be a great buying opportunity to look for moves back up into this resistance up in this area. So if you were to get down close to this support level, you could have a 345 pip run. There's a possibility there. And notice how nice that support level is all the way across. Okay, so I would look for a buy there. At this time, I'm really not looking for a sell or a buy unless I was going to move all the way down to scalping. And we moved down a little bit farther, got a clear ABC retrace. My problem with that is I really don't have divergence. Even if I drop down to 15-minute, no divergence there. 5-minute, there's just no divergence anywhere. So again, kind of the signs of the times where we're at in the season here, coming into the end of the year, you expect things to be a bit choppy. Now, if I was going to scalp this, let me show you a quick scalping technique that is possible right out of the gate here. I would find my lower high as we're moving down. We have the highest high, lower high, lower high. We've broken down, and now we have our lowest low. If we move up above this resistance level, this lower high, you can see how that resists all the way across. So we'd expect a bounce there and a move back down. If we break that, then on the 5-minute, we've gone bullish. So if I'm going to be scalping on the 5-minute, I'd want a break of that, significant, not 1 or 2 pips, but a decent move up, candle close above, not just a rejection candle where we spike and close below, but an actual close on the 5-minute above this level. And then I'd want at least a 50% retrace, which if you haven't gone through my foundational course on market movement and trend following and how to know when a trend ends and another trend starts, then you wouldn't understand this necessarily, but we'll get there in these the free courses I'm providing. So we look for a move up, at least a 50% retrace back, and then we can go ahead and set our stop down behind our lowest low. Now, part of the condition of this kind of a trade is that we actually do have divergence starting from all the way back here. And if I do my little tester, bring my vertical line, you can see how the momentum oscillator started going up and our candles are still dropping down, all the way down to where my candles started going back up. And sure, the momentum oscillator did follow that, and that's expected, and that's fine. But it's this area in here that before the candle started going up and the momentum oscillator followed, or is going with, we had this great divergence. So this actually is showing the momentum was turning well in advance of the candles moving up, and then they started moving up. So that's showing trend exhaustion. If we get a trend break, we've already, let's pull a trend line from the last move down. We've already broken trend line, now not sharply, just kind of gradually, but if we get this boost up, break this resistance level, then retrace back down, there's an opportunity for a buy in that area, and I'd want to look to dump that buy somewhere before the top up in here, at least partial lots, and then bring my stops up to follow the Elliott wave patterns. Now I understand that some of what I'm teaching right now, going over, is way above some of your heads. That's fine. You've got these free videos that are being put out that are developing, and as you stick with me, you'll get some education and all that. And let's look at the US yen. We had this weekly triangle, which I talked about for months, and then we got the breakout as we expected, and this really nice move up, which is typical. If you consolidate in the fourth wave, your fifth wave tends to be fairly aggressive out of triangles. We haven't had any significant retrace at this point. Now if you're using our trend following technique, which is in our 10 foundational videos, you would have just gotten in somewhere in this area, and your stop loss, if you're going off of the daily chart, you just keep moving your stop loss up behind the higher lows. And notice that our higher low never got taken out. Okay, so you just keep moving that stop. You don't have to wonder when to take this trade out. You just keep moving your stop. This is called psychological control. Okay, we have another little move down, a little triangle, and then we popped up. So if you're running this on the daily, your stop would be in this area. Why wait for it to come all the way back down and take out your stop down in one of these areas? Okay, that's almost equivalent to not having a stop loss. Good trade management would be to keep moving your stop to protect your profits as you move up. And this is following what then we would call a trend line. And this is a key to consistent profits, is quit trying to guess when this is going to end. The trend is your friend until it ends, and you can keep following these up. Now that's if you're trading on the daily. If you're trading on the 4 hour, then any significant retracement, which depending on your standards whether this is significant or not, for me, once I start getting into seeing that the divergence is happening on the 4 hour, I start following a little bit tighter, and I start seeing any kind of consolidation as a little more significant because I have a divergence. When I see that momentum oscillator diverging, and I start to pay a little more attention to consolidation periods. And you can even get more aggressive with your trend following and drop down to the hourly. And so if we got a dip here and then move back up, then you could move your stop tighter and tighter as that divergence keeps increasing. Okay, so that's how I'd be following that. I'm not looking for a short on this until we break that higher low. We'd have to break one of these higher lows depending on what time frame I want to be on. And of course, overall, we're expecting this wave 3. We have wave 1, 2, 3, wave 4 consolidation, and wave 5. We're expecting that to move up into this 127 before we get any significant retracement, any ABCs, but that's on the weekly. On the 4 hour, we could very possibly get a move back down to this trend line anytime, and we do have the divergence. But at this point, we're definitely bullish, and if we go out, let's go out to the monthly. You can see that resistance level in there that we're expecting the 127 retracement, and that'll be 5 waves up. And so at that point, let's see where that Fibbo level comes from swing high to swing low. Okay, that's close to the 78. So 138% extension is going to be right in that 78% area. For those of you that know harmonics, that would be an X wave, an A wave coming to a 78. You'd expect an ABC retrace because we have this nice divergence, and then a pop up into the 127, 138. That would be the first resistance for a bullish butterfly. I'm sorry, actually a bearish butterfly, because at that point you expect the D leg to drop off. So we're getting pretty predictive on this U.S. yen, and plus we know the fundamentals. The Bank of Japan is quantitative easing, so we're expecting the yen to continue losing value against other currencies, and as that happens, we'll expect it to continue moving up. But in all waves, there's always the retracement factor. So we'd expect sometime around in this area an ABC retrace, maybe shallow, but still an ABC retrace, and then we'd want to catch that C leg, or maybe wave 3 up for its ride up. So continue bullish in that, basically buy any retraces up to about the 110.91 area, any significant retraces buy. That's our plan. Now, I told you I was going to go over the currency that does look like it has some potential to trade this week. All of these others would simply, the pound, maybe some scalping, US yen, trend continuation, buy significant retraces if they happen. I'd be extremely cautious about selling on the yen, but the pound, you might be able to get into some decent scalping on the 5-minute over the next few days. Let's look at the Aussie USD. Okay, what do you notice when you look at this chart? You should, if you've been through some, like especially the intermediate course, you should notice some things. We have our momentum oscillator up. You should first off notice divergence. Let's go to where our lowest point on the 4-hour on the price and our lowest point on the momentum oscillator. And then you draw a line between the two. This is how you find divergence that matters for our system, our predictive system. So clearly we have divergence. So what's happening after that, we measure X wave. Some of you this is review, some of you this is absolutely new information. And in our beginner or our Quantum Forex intermediate course, this is where we teach this stuff. You have to have a trend line break, which we do have. Suppose we could trend line you basically minimum 2 points. We have this trend line break. You have to come to a minimum of 38%, 50, or a maximum of 61.8 retracement for our 1, 2, 3 setup that we like to call it, which we qualify a bullish move in this case. And you have to have divergence. We have all that. We came to the 38, so we're good for a bullish expectation. Now, what we like to then do is look and start doing some Fibbo measurements with these wave patterns, and that's where we get into what we would call harmonics. So we're going to drop down to the hourly. Now we call this X wave, and we have this ABC. Now the key wave for harmonics initially is this A wave down. Now we're going to call this wave A. Let me go back out and explain something. We're going to call this X, and this is A, this is B, and we're expecting a C wave move up unless it gets extended and proves to be a wave 3. Otherwise, we assume it's an ABC retracement. Why? Because we're assuming the trend is going to continue. The trend is your friend until its end, until it proves it's broken. In other words, this high would have to break for us to assume that this was not an ABC retracement. If this high breaks, then we assume we are moving into an impulse wave, and then this wave would be wave 3. Stick with me in subsequent videos and that'll make sense to you. Dropping down then to the hourly. Look how we've nicely come just about within a few pips from tagging the 61.8. That is the initial leg of either a bullish crab or a bullish Gartley. Okay, the bat does not do a 61.8. Neither does the butterfly. The butterfly does a 78. Okay, so this right now is setting up for a Gartley. If this 78% fails, we hit the 61, we retraced, we're moving down. If this 78% fails, then we're looking for a continuation down below this level, this 100% level, down into the 161, which then would be a bullish crab. Okay, so basically a bullish crab in this case would be the failure of a bullish Gartley. So if the Gartley fails, presses through past the 88%, you want to look for, let it break the bottom, retrace, and then ride that on a short down to the 161 and look to exit at least some of your lots at 161. Bring your stops tight, because there's good possibility with this kind of divergence that you would pull back and start to move bullish on the crab. Now, our first order of business though is to see if we're going to get movement down here at the 78%, which would be the Gartley. So what we want to do is drop down to the lower time frames. In this case, we just keep moving down hourly. We're looking for divergence. So let's go ahead and put a vertical line. We do have a little bit of divergence. Okay, as I'm producing this right now, it's 2 p.m. Pacific, and we've just opened the market, and we're real close to that 78%. And you can see that we do have divergence now, quite steep divergence. And as we continue down to the 15-minute, okay, nice divergence. So at the 78%, you could get in anytime now to the 78% on a predictive buy. But if you want to be a little safer, you would want to qualify your buy. And one of my qualification standards requirements is that I break, in this case, the lower high. We had a retracement, consolidation, then we broke lower. So I'd want to see this come down and hit the 78. And even if it doesn't hit the 78, but we break this lower high, this resistance area, move up, back down at least 50%. And what it does for me at that point is gives me a real nice clarified way, entry point, clarified place to place my entry with my stops and my take profits. My take profits are going to go well above this wave. So real nice risk to reward ratio. Remember, there's three things that you need to take a trade. You need an entry price, you need a stop loss, and you need to take profit. If you don't have those three things, you can't measure your risk to reward ratios. You cannot therefore measure your money management. You can't use money management without a stop loss. This gives you very precise places. If you were to wait for this to break 50% or more retrace, stop simply go down behind your lowest candle wherever they happen to be. In this case, if we drop down to the 78%, move back up, took out our lower highs here, and then 50% or so retrace, you could literally have a stop loss of 14 if you want to be tight. If you want to even drop down below the 88%, which of course would be safer, give yourself a little more play, and you'd also use an average true range of a stop loss, you could have a 30 pip stop loss in here. Okay, now if you can get in on that, and if this breaks below the 88, you want to be out, because like I said, you're looking then for that bullish crab to start to develop. Let me show you where your take profits would be. We'll go back out to the 4 hour for a take profit. And then after this, I'm going to wrap this up since we're getting over the 20-minute mark here. We're going to pull a Fibbo from what we're calling the top of wave A to the bottom of wave A. And this 127%, see how nicely that comes into the bottom of this resistance, where you would definitely expect some level of retracement. So let's go ahead and plan on taking at least half of our lots out of that point. So you've got 131 pip take profit for a maximum of a 30 pip stop loss. And 120 pips would be a 1 to 4 risk reward ratio. So that's real good. And of course, what you could do is go ahead, once this breaks and retraces, you could put half your lots in, stop behind the lower candle, other half down behind the 88%. You go ahead and enter now, put with half your lots, then let the other half qualify. Any number of ways you can do it that suits your personality. But currently right now, this would be a predictive trade, and actually it hasn't hit that 78, so I would caution anybody from getting in yet. Gartleys typically have pretty precise Fibonacci levels, and the first one is the 61.8, which we basically nailed. You'd like to see that drop down, hit that 78 and bounce. Okay, potential on where this could go. Let's just pull out to the 4-hour and then the daily. We're right down at the double bottom on this, and notice, let's actually just clear all this stuff off of here. We're right down here on the daily at the bottom. We've got a nice rejection candle. And so you can see the nice possible retracement on this. So this could easily come to at least a 23% retracement, which would be up in this area, or a 38. But 23% are usually your minimum retracements if you're going to have a continuation. And even if it came to that 23%, you're looking at a possible 180 pip movement, or the 38% is a 316. And then if you, like I showed you on the US yen, if you just find whatever time frame you're comfortable on and then keep following those higher lows, then you don't really have to be too concerned about where your take profit target is. You like to have a predictive take profit just so you can set your risk reward ratio, but then you want to be able to follow the trend and follow those higher lows in order to take your profit out. Okay, I hope that helped to give you an idea. Again, you're not going to miss too much this week if you stay out of the market, probably. Of course, there's always things happen and we could get some big jumps, but as far as consistency in the market right now and safety, there seems to be a lot of ups and downs that are a little bit unpredictable, except for when we get into that Aussie USD and we have that opportunity for that possible Gartley. And if that Gartley does fail, then remember that bullish crab down below the 100%. You might be able to catch a retrace and short that down to that 161.8. Okay, that's it for now. Make sure to leave comments, and if you'd like to email me, it's mark@quantumforex.com, and I'll have that on the screen there. God bless.